There is rarely a shortage of things that worry us. Perhaps the biggest risk at the moment is that government bonds have never been so expensive. Interest rates will need to remain at very low levels for an extended period to justify current prices. There are few standout investment opportunities at present. However, if bond markets are correctly priced, equity markets might provide long-term average returns of 5, 6, possibly even 7% a year. And these appear very attractive compared to bonds offering yields of 1 or perhaps 2%. And indeed, the likely return that you're going to get from any cash deposits. We can only guess at the impact that Brexit will have on the UK economy. We suspect that at some stage over the next 12 to 18 months, the Brexit negotiations will start to look really grim, and it could hit UK markets, even if only on a temporary basis. There is a significant risk that the current government falls and we're forced to return to the polls. A Corbyn government would not be well received by the financial markets, and his proposed increase in corporation tax would definitely hit the all-share index. As a result, we're maintaining a low exposure in UK risk assets. Many of the larger companies listed in the UK market have overseas earnings, and these have become more valuable as sterling has fallen. The UK faces some major political risks over the coming quarters, as well as the economic consequences of Brexit. This makes us wary of investing in the UK. That said, sterling has fallen a long way and could rebound if we've been too pessimistic. This would result in foreign exchange losses in the portfolio. It's a real headache for us, and we try to balance out the risks as best we can. The British government borrows significant amounts from investors each year, as do governments from around the world. Lending money to emerging nations involves additional risks for investors, but tend to offer higher returns to compensate for this. Compared to other investments, we believe that emerging market bonds are attractive on a risk-reward basis. The Japanese stock market seems favourably valued compared to other developed markets. Japan faces a number of domestic challenges, but the economy is doing reasonably well, and its companies should benefit from the pickup in the global economy. Many investors seem to have forgotten about Japan, and we think this offers a reasonable opportunity to us. The Polar Fund focuses on insurers operating in sectors such as building insurance and personal liability insurance. Insurance is often seen as a somewhat dull and complicated business, with many companies being poorly managed and not particularly profitable as a result. However, well-run firms can generate steady returns and not particularly sensitive to economic conditions. While insurance businesses face a wide array of risks, we believe that the market is undervaluing the stable return profile offered by certain companies within this industry. Much of the recent equity market return has come about from a general revaluation of asset prices. Investors should take care in extrapolating past returns. Consistent double-digit annual returns are a thing of the past. Stock markets might generate returns of an average of, say, 5, 6, 7% each year, and this will be very generous compared to where interest rates currently are. I guess there are two elements to this: what we do and how we think. We've got a large analyst team who sit in the heart of the asset management community and enjoy really good contacts and relationships with key global investors. These insights provide us with a broad understanding of what's happening within financial markets and influence how we shape our clients' portfolios. Secondly, both we and Watterson Financial Planning tried very hard to focus on generating the investment outcomes that clients are seeking. We're very conscious that we are often investing a large proportion of a client's nest egg. Now, it's not to say that we don't take risks when investing. After all investment involves some degree of risk. What we try and do is manage these risks as best as we can to ensure that the overall level of risk is appropriate for you and that we can help you meet your financial objectives. Square Mile employs 12 fund analysts, and their research provides our business with its core value add. We're going to take quarterly reviews of each fund that we rate, and this involves a regular schedule of meetings with the managers of a fund within each year. Well, thank you very much for listening, and I hope you've enjoyed this update.